Now, the teams talk to you about total asset allocation. Today, I'm going to talk to you specifically about what we do at Intelligent Investor, and that's mostly looking at Australian equities. Intelligent Investor really has two arms. One arm looks at research on ASX-listed stocks, and the other arm actively manages two equity portfolios, a growth and an income portfolio. So today I'll focus on the portfolio business. We've outperformed the market for 15 years now, and we've done that consistently and by quite a large margin. So I'm going to reveal some of the secret sauce on how we actually go about picking our stocks and how we put our portfolios together. Won't spend too much time on this. The portfolio clearly is simply the stocks that you're holding at any given point in time. The mission, this is really important. The way we see the world, we want to maintain a portfolio that's as undervalued as possible for a given level of risk. Now, that doesn't sound very profound or controversial, but that is a very contentious point, because what it doesn't say is anything about holding specific sectors or anything about quality companies. I don't care about holding quality companies. I'm not interested in curating a collection of high quality and expensive businesses, because that's not the way to make money. The way to make money in the market is to buy something for less than it's worth. And we're not going to buy Woolies at $40. We're not going to buy Transurban at $10. We're not going to buy Blackmores at $220. Those are all wonderful businesses, but they're far too expensive. What we're going to do is we're going to look at the market regardless of asset class. So we don't care whether we buy a telco, a healthcare business, an infrastructure stock, or a tech business. We're interested in cheap stocks, something that's trading for less than it's worth. And that's what we do. We scour the market and look for those specific opportunities. If that's the mission, the method is remarkably simple. The secret to making money on the share market, that was a dramatic pause. The secret to making money on the share market is simply to hold. You often get these images of investors in all this frenetic activity. They buy, they hold, they yell, they shout, they draw and they scream. That's not wealth. That's not the way to make wealth. That's not the way to invest. The way to invest is actually to channel your inner Zen monk. Do less, have discipline, have patience, and just hold. The buying and selling is just a means to an end. It's the holding that actually creates all the value. And that's what we need to do more of. Less activity, more disciplined inactivity. Mitch has talked about the passive approach to stock investment, so I won't spend too much time on that. For most people, and indeed for us, we aim to hold around 12 to 30 stocks at any one time. And we'll hold those in different proportions depending on our conviction and the interesting strength of the idea. But that's probably a good rule for general. If you're holding a portfolio, somewhere around 12 to 30 stocks is about where you want to be. If we're so smart, why not just buy the best stock and hold that? Well, it's probably best explained by Donald Rumsfeld, who had a contentious career as a politician, but a blindingly successful career as a philosopher, very briefly. You might remember that Donald Rumsfeld gave a mystifying interview where he said that there were known knowns, there's known unknowns, and there's unknown unknowns. And I spent weeks trying to decipher that. I think what he was trying to say was that the world is an unpredictable place. And our job is not to try and predict the future. Our job is trying to prepare for a whole lot of different futures. And when I think about stocks, I don't think about certainties, I think in probabilities. We want to think about what's the most likely scenario, what's the share price telling us about that scenario, and is something mispriced? So we think in probabilities. The other thing we do, and this is perhaps unwise of me to mention, it's okay to lose money. Everyone needs to be aware of this, and I want you all to say that to yourselves at some stage during your investment lives. It's okay to lose money. The aim of investing is not to make money on every single investment you make. Indeed, we diversify specifically to give us the opportunity to take mispriced bets that may not work out, but if they do work out, they can multiply your money. We don't do that very often. We do that every occasionally. But I think if you don't lose money on a couple of trades, you're not trying hard enough. And we don't mind losing money on one or two investments if it means that gives us a chance to make a very large return when those ideas do work out. And finally, we're not soothsayers or prophets. Investing is a process. It is not about prediction. We're not going to predict which company is going to be the world's largest. We don't know what's going to happen to interest rates. I don't care about those things, really. Investing is about process. A disciplined process will lead to good investment outcomes, regardless of what happens in the market, regardless of what happens to management. If you have a good process, you'll have a good outcome. So a lot of what we do is about refining our process, making sure that what we do is robust enough to overcome any market conditions and to overcome even a fool running a business. Warren Buffett has this great quote. He says that you better make sure that you're invested in a business that any fool can run, because at some stage a fool is going to run it. And this is what we try and do. We're trying to look at the underlying economics of the business and foolproof it, if you like. So the aim of investing, as we do it, is trying to buy something for what it's worth. I said we're not soothsayers, we're not prophets. What we are is actually hunters. And what we hunt is mispricings. I mentioned before, we're not interested in high-quality, expensive stocks. Every manager will tell you we're after something high quality, with recurring cash flow, with good management, blah, blah, blah. The problem with that is if everyone is chasing the same stock, if everyone is chasing the same idea, then that popularity is reflected in the share price. You cannot have a cheap share price and a popular stock at the same time. The fact that a share price is cheap tells you that the stock is unpopular. So the skill is not in identifying good businesses, anyone can do that. The skill is identifying those stocks that are mispriced. Something is cheap. Is there a good reason that it's cheap, or is it deservedly cheap? And that's the investment skill, and that's what our process is all about honing. Now, buying cheap stocks is difficult. We always look where others aren't, and we employ what Howard Marks, who's a famous American hedge fund manager, calls second-order thinking. First-order thinking, I think, is what a lot of investment managers and analysts employ. It's thinking in linear lines, extrapolating a trend that exists today in a straight line all the way into the future. We saw this classically in Blackmores earlier this year. Blackmores was growing fantastically. Everyone thought, great, 100% growth per year. It traded on a hefty multiple. The share price went up, and everyone thought this was going to happen indefinitely into the future. Things don't happen in straight lines. We have to train ourselves to think in terms of second-order thinking, which says that, yes, Blackmores is a good business. There are good things happening, but it's being priced as a great business, and competitors can squeeze margins. So when we employ second-order thinking, we don't think in straight lines. We think in terms of reversion to the mean, and we think in terms of probability. Which brings me to a couple of ideas that we've recently added to the portfolios and that we've recently recommended at Intelligent Investor. We're going to talk to you about two ideas. These aren't necessarily our strongest ideas at the moment, but they are ideas that we currently own. They are both ideas that I personally own, and importantly, they are ideas that demonstrate the process we use to pick stocks and how we go about thinking about stock market investment in general. The first business is Amaysim, which some of you may be familiar with. Amaysim is a recently listed telco business. We recommended it as a buy below 220, $400 million market capital. So in the jargon, it's known as a mobile virtual network operator, which is a fancy way of saying it's a mobile reseller. It leases mobile spectrum from Optus and wraps up products and sells to its own retail base. The consensus has been really unfavorable until recently about this stock. It listed and quickly fell back down to, it listed at $1.80, went all the way up over $3 and then fell back to about $1.60, which is when we got involved. The consensus has been pretty unfavorable. when we upgraded this as a buy, the CEO actually called me, and I was shocked to hear from him. And I asked him, so why are you calling me? And he said, well, you're the only analyst. We were the only people with the buy on this company. And as results have improved and as the business has done better, I don't hear from him anymore. And I'm guessing it's because other analysts are now catching up and starting to see what we saw from the beginning. But on day one, this didn't look like a great business. It's not cheap. It's got a PER of 34. So if you're looking for a low PER business, this automatically gets wiped off your list. A lot of analysts say it's just a reseller. It's not a resilient business. It just takes one product and resells it to someone else. Anyone can do that. There's no competitive advantage. And in fact, it has lots and lots of competition. There are hundreds of mobile resellers. And in fact, the Australian industry is a graveyard filled with failed mobile resellers. Why is this one any different? And it's also a hostage to Optus. Optus controls about 60 to 70% of its revenue. Without the Optus mobile network, this business has no business. But this was our investment case. We looked at this business and thought, yes, it's just a mobile seller. And yes, the industry is littered with failures. But this is the one company that's profitable. Why is this one profitable? And we looked at the economics of this sector. When a Mason finds a customer, 60 to 70% of all that revenue goes directly to Optus, but the 30% that it keeps as gross margin, that goes into paying for things like billing, marketing, customer service, and customer acquisition. All those things have been automated by a Mason. So a Mason has built a scalable business where it costs $0 to get the marginal customer onto its system. So if you're a customer and you walk into an Optus store and you sign up to an Optus network, that costs Optus 10 times as much as a Mason signing you up online on their website. And this delivers terrific economics. This means that every additional customer a Mason adds to its network comes with extremely high incremental margins. So even though the business doesn't look like it's very profitable today, as it grows and attracts more customers, the economics actually get better. The margins increase. We made this case when margins were at 7%, and they're now about 12%. And we think margins can get to 15%. Internationally, the best MVNOs generate about 15% operating margins. And I think Mason is on its way to generating similar types of returns. It's also a low capex and high cash generating business. Optus this year will spend about $2 billion upgrading its mobile network. Yet Mason made a new agreement with Optus to lease their network for less money than last year. So Optus is out $2 billion on these mobile upgrades, and Mason gets all the benefit of those mobile upgrades and actually pays less money to use them. This is incredibly attractive economics. The greatest cost of a mobile network is actually maintaining it and building it up so all the customers can get on at the same time. This is incredibly expensive. Telstra is spending $3 billion a year maintaining and growing their mobile network. As a reseller, a Mason doesn't have to spend anything. All the cash that comes in, all the profit that comes in a Mason's door is available for distribution to shareholders. There's also a cost advantage. A Mason wasn't profitable until it had 600,000 customers. It now has over 1 million customers. But if you're a competitor trying to compete with a Mason, more likely than not, unless you have 600,000 customers and no other MVNO does in Australia, every customer you have is unprofitable. Whereas if those customers were plugged into a Mason's network, they would be profitable. It's incredibly hard to compete with a larger business when scale matters as much as it does in this industry. And as a Mason has grown its customer base, they've actually become about 10% of Optus's entire mobile subscriber base. And if you go back 5 or 6 years, all of Optus's growth, all of it, has come from a Mason. So Mason represents a large chunk of their mobile business and all of their growth. We think the advantage when it comes to negotiation is actually tilted in a Mason's favour rather than Optus's favour. A Mason isn't hostage to Optus. Optus is hostage to them. So we brought new insight when we looked at this. We thought that this wasn't being priced for its potential, that the market was seeing a poor quality, lousy reseller that would always make a 7% margin, didn't understand how the economics of this industry actually worked, and that with new customers, the margin actually improved. Thought the market didn't understand that this was a capital light business, that you couldn't just compare the PE to Telstra or to TPG, which is what they were doing. We were seeing analysts comparing this multiple to Vocus multiples and TPG multiples without recognizing that they're completely different businesses. And because this is a $400 million business that only employs $30 million of equity, and it makes $20, $30 million in profit a year. Incredibly high return on assets, incredibly high return on equity, and very high free cash flow because everything it earns in profits it can pay out as dividends. So that's Amaysim. The fund owns a chunk of Amaysim, as I mentioned. The other company may not be as familiar to you, and this is a little bit hairier. Last year, when I did a similar presentation, I talked about two companies, South 32 and PMP. South 32 went on to more than double, and PMP went on to rise 70 or 80%. So the pressure was really on to pick two winners this time as well. This one was a contentious choice because this is a hairy situation. You may not have heard of Fleetwood Corporation. We've recommended as a buy below 180. It's a conglomeration of businesses, really. It's a couple of businesses. Fleetwood manufactures and sells RVs in Australia. They also manufacture temporary accommodation, modular accommodation it's called, and they sell accessories to RVs. So there's really two parts of this business, and it has a market cap of $120 million. I should say as a disclosure that the growth fund owns it and I own it personally too. Now, when we recommended this, a lot of people thought we were nuts. You only have to look at that share price to see that this is not your high-quality, high-priced, high-PE business. It did have some exposure to the mining boom. When the share price got to its highs back in sort of 2011, 2012, it was because Fleetwood was manufacturing lots of accommodation to mining villages in WA, and it was making bonanza returns on these things. It was making so much money, they didn't know what to do with it. And that's why the share price rose. As the mining boom subsided, all that income disappeared, and all of a sudden, this is a business that started to look in trouble. The share price collapsed, and even today, with the much lower share price, this is a business that actually makes zero profit and trades on a PE of over 200. A lot of people say this is just a lousy business at a lousy valuation. Well, let's unpack it a little bit and decide. So here's the investment case. I don't think this is a poorly performing business. This is a business with a poorly performing division. When you pull apart the income statement of this business, you find that there are two divisions operating here, the RV business and the manufactured accommodation business. The manufactured accommodation business actually makes good money, between $10 and $15 million a year, which for a company valued at $120 million a year isn't so bad. You don't end up with a P of 200, it's a P of sort of less than 10. The problem is that every dollar it makes in accommodation, it loses in RVs. So it loses about $10 million a year in RVs. So it's got a problem with one division. There is a profitable business in here. It's just obscured by a poorly performing division. So what are the chances of success in this RV division? That's where we spent a lot of time, and I spent some time trawling through RV shows all over the place trying to figure out. So this is what we thought. RVs, manufacturing recreational vehicles, is not like building a car. You don't set up a factory full of robots and push through output. It's not a high fixed cost business. It's a highly customizable, labor-intensive business. So there's a high proportion of variable costs. So how can you lose money when a lot of your costs are variable? You'd think that if demand was falling, you'd just cut back on your costs and you'd still maintain margin. In fact, Fleetwood for about 25 years has made very good returns on RVs. losing money in this division only started happening over the last few years. And it happened because Fleetwood had not released a new product, a new RV product, for 10 years. And they had not done that because they were so busy making money in the mining boom, in their accommodation business, that they didn't invest in their RV business. So when the mining boom ended, all that revenue disappeared, and they were left with this whole suite of old-fashioned and uncompetitive products. And that bore fruit in the result. That's why they're losing so much money. So you can actually turn that around fairly quickly. The first thing to do is to reinvest in your product again and start releasing new products. And that's exactly what they've done. I've been to trade shows and seen the new products. They are just as good as anything else on the market, and they've now refreshed their entire range. They've also said that they're running their factories at a very low utilization. Because they were selling 10-year-old products, the demand for their products fell away, and they were left maintaining a very high cost base, which they did not want to cut. It's difficult to rehire people once you sack them again. So they're waiting for demand to come back. And when demand comes back, they can recapture the margins they used to make. If demand doesn't come back, they can then readjust their cost basis. In any event, whether demand comes back or not, it's unlikely that RVs are still going to be losing $10 million 2 years from now. In the worst case scenario, they would have cut back their cost base and you eliminate their losses, in which case you're left with a business that earns $10 or $15 million a year, which is fine. In the best case scenario, they actually make some money out of RVs, and you might end up with a business earning $20 or $30 million a year, in which case this business looks like an absolute steal. There's also other advantages here. This is an incredibly cash-generative business. It reports zero profit, but it generates $30 or $40 million of cash every year. And that's because of accounting quirks we won't get into today, but it's important to realize that the reported profit of a business is an accountant's trick. It doesn't necessarily tell you exactly what you need to know. You need to dig a little bit further to find out how much money actually comes out of a business. And when you do that, there's more than it appears in this case. There's also a view that Fleetwood is a mining services business and that it's still attached to the mining boom, which it is not. Its revenue now comes from caravan operators, from the education sector, and from the affordable housing sector. There's very little revenue here coming in from the mining business anymore, and the mining revenue that is coming in is contracted. So that's a fairly hairy situation. When we first bought into Fleetwood, it had a heap of debt, and it looked a lot worse than it is. Since then, the debt has all been repaid down, and the situation looks a little bit better than it did initially. We've made a little bit of money on it. I think it's up about 40 or 50% in our portfolios. But I still think it looks okay. And it still sits as a buy on our recommendations page. I could go on for a very long time talking about stocks, but I think I better leave it at that. and remind you all that investing is a skill that we all need to improve to get better on. It's not about hope, it's not about luck, it's about process, and we all need to refine our process to become better investors. Investing is not about predicting the future. Consider yourself hunters looking for mispricings, and don't just buy the best quality business because someone tells you it is. And most importantly, if we're going to buy cheap stuff, it means looking at ugly places, looking at industries no one else is looking at businesses no one else is looking at. I can tell you that no one is looking at Fleetwood right now. There are no analysts looking at a stock with a 200 PE thinking, ooh, I've got to get some of that. Just doesn't happen. And you have to uncover companies a little bit deeper, unpack them a little bit better to gain an insight over the market. Thanks. Oh.